You would make a terrible substitute teacher, by the way, because like you can't break any of this up.
Matthew, thank you. Okay, so we're gonna get started. You all have to break. I'm not gonna do any introductions because two people on stage who won't shut up. That'll be the conversation. We're gonna be taped, so we're on taped conversation. This is for public view, so just keep that in mind. A couple important things. We're playing a side game, a little game show with the speaking. So if the words that are spoken by anybody in the crowd or by our two panelists or by myself, if any of these following words come up, you're required to drink. Okay. So one of the words is Fed.
Buckle up, buckaroos.
The next word is dollar. And we wouldn't want to forget rates. So Fed, dollar, rates will be your opportunity to hydrate.
Surely, so you're trying to kill
I'm moderated.
We're exempt up here.
So, okay. So anyway, for those who came in, if the words Fed, dollar, or rate comes up,
Drink.
So
Fed, dollar, or rates?
yeah, you have to drink. Okay. So why did I do it that way? Okay. So as you know, there's been some news earlier last week and some news this week. The big news, obviously, the BLS, which we've gone over tonight. Also, the empty Fed spot that happened the same day, and recently it's been filled.
Thank you.
So we could have a boring conversation about, the BLS or the Fed, independence. But we're going to try to take it a little beyond the obvious. So I don't think I'm going to have to ask any more questions because I think these two will be able to keep going without me. But if I have to, I'll intervene. But the first question for either one of you to take and then discuss is obviously there's, whether it's the CPI or it's the labor statistics, there's a hole in the data. So the question is, can we believe the data? How do we get faith back into the data? And what do we do if there's absence of good data?
All right, I'll start making up shit about this question. All right.
Through without saying Fed. Oh, drink.
Is $50 what your liver is worth?
Yeah. So to start off the conversation, let's divide the data into two broad categories. There's opinion data, attitudes. That's what Holly does at NFIB. That is appropriately done as a survey. Now, there's problems with surveys, but the problem with what the BLS does and Commerce does, BEA, is that they're using surveys to try and derive actual hard statistics. Let's survey 120,000 businesses. Hopefully we'll get 40% of them to answer the question. Hopefully we'll get a collection rate of around 90%, and then we'll project what the entire state of the labor market is. The problem, of course, is that the response rates are going down, but the reality is they're never going back up. They're only going to get worse. So whenever they say, well, yes, the response rates are going down, well, they're not getting better. So we're going to have to find a better way to do this. Now, there are better ways to do this. You could look at actual data from IRS withholding, state unemployment insurance. You can look at, the payroll processing firms. We all know ADP on Wednesday puts out a data source. That's 24 million people in their database right now. We could add other types of services to try and approximate what is the actual happening with the labor market instead of inferring it from a sample set that has got an ever decreasing amount of people responding to it. By the way, why I would argue to you there's two reasons why surveys are falling. The one is I call the survey monkey problem, because survey monkeys killed it for everybody because they send us 75,000 surveys and we don't care about any survey anymore. So that's one big problem. The other one is social media. I'm old enough to remember when, if you got a phone call and it was Gallup, it was a big deal. Somebody was asking your opinion. Now you can go on social media and you can vomit it all day long. So I don't need Gallup to call me up to ask me what I think about things anymore. So no one answers surveys, and that is going to be a big problem. The last thing I'll say on this, turn it over to Cam, is okay, you agree with me, but that's cost a lot of money. I'll throw out an option at you and you could shoot it down, or it doesn't have to cost anything. You could call Alex Karp at Palantir. You could call Sanjay Nadella at Microsoft. You can, ask them or somebody similar to them and say, would you fix this and do it for free for your country? And they probably would. They're multi-trillion-dollar companies. Now you could argue, well, you're going to be giving them access to sensitive data and stuff. That's true, but that can be controlled, and they're going to do it for no money. I would guess if you asked them to do it, they would. And that maybe we could do this now, because there's a lot of work that needs to be done. The IRS withholding database is a mess. We don't use it because you can't. State unemployment insurance is notoriously a mess. We see that with the initial claims and the continuing claims data as well too. So those are just some of the ideas about how to fix that.
And by the way, just to be clear, one of your ideas is that we can replace the Fed with private enterprise to step in and help get the data.
Yes, I mean, we could do that. One quick example, when you brought that up, is that BLS has recently gone off of surveys for used car prices, and they now use JD Power. For some unknown reason, it took them 2 years to make that change. I don't know why it took them to make that change. JD Power has been collecting the data for a long time, but I know that they're very deliberate and they're very thorough, but that seems to be a little bit of an overkill right now.
Do you have time?
Dearly beloved, I have gathered you all here today to mourn the death of indicator economics. I think in the last 5 years post-pandemic, we've seen the breakdown of what we would typically expect data, assuming it can be trusted, of how it would impact markets, whether it's the breakdown of leading economic indicators being absolute and completely garbage as far as their ability to correlate with equity market returns, or even predict a recession. Of course, as you've had indicators flashing red signs of recession, whether it's because they're relying too much on surveys or relying too much on market-based data like 10-2's curves. We can talk about those being manipulated or influenced by Fed policy. But I think the oh, yes. I think that, and also I said rates, so drink again. Thank you. I think it's fascinating as a market participant is where Jim can talk about the ability to, or the need to change data or the collection of data to make it more reliable, to make it have a better view into things, is that what do we actually do about this as investors? Because if you had relied on all of these data points over the course of the last 5 years, you've gotten the market absolutely and completely wrong. At the same time is that there's very little insight then into where the cycle is going if we can't trust the survey data or the actual data that we've been using. So I think what it leads to then is a reliance of what the market itself is telling us about where the economy is going, and then that can be this very interesting, fascinating feedback loop where it's being driven by things like flows and the insights into where the world is going just become much murkier. And so I guess the question would be to you, Jim, is that if you move more things into the private sector as far as the sources of data, do markets by definition become less efficient because information becomes more asymmetric?
I don't know if they become, it depends on what you're doing with that private sector data. If it is publicly available and everybody can get it, and you can get it in, some kind of an API so that you could manipulate it and do what you want with it. No, I don't think that would be the case at all. But I do think that the case right now is there is a lot that we don't know about the data. So go back to the payroll report. 120,000 companies are surveyed. They have a response rate of around 42%. So what's that in back of the envelope is something like 50,000 companies are reporting out of 120,000. And in the first guess, the number we got last week is 73,000. They're getting a collection rate of those 42% at around 55%. So now we're down around 25,000. They're interpolating what the rest of the data is going to do. They do not, as far as I know, tell us what assumptions are you using in your interpolations. And I'll give you a great example. One of the big issues I think that goes unreported about the labor data right now is population data, right? There are 163 million people in the country. So when you're measuring the labor market, you're basically measuring population growth. There's an argument to be made that the country right now has zero to negative population growth for the first time in its history right now because of the shutting of the border. If that's, in fact, Trump tweeted that out 3 days ago. He said, we have net negative immigration, more people leaving than coming into the country for the first time in our history. We have the lowest fertility rate in our history. When you add it all up, the population growth in this country might have never been lower in 200 years. We might only, if there's another statistic economists talk about that doesn't get talked about much, the break-even rate on how many jobs we need to create every month to meet population growth. The American Enterprise Institute is estimating that number might be 0 by next year, that any positive number in payrolls is enough. And that's all we need. But we're still stuck with this thinking it's got to be 80 to 100,000. Trump thinks that. He wants to put somebody in the Fed to jam rates down to 1% because he thinks we need to drink.
Actually, double drink. Rates Fed.
Because he thinks that we should be churning out 100,000 jobs a month. Not with this population growth. We can't. And that's part of the problem. One last fun fact for you about population growth, courtesy of the FT 2 days ago. The population over 16 in the country, can be broken down to native-born and foreign-born. The native-born population has grown in the last 7 months by 2.8 million. Now, if you go through the numbers and say how many 15-year-olds became 16-year-olds, and you assume no one in the country died this year, and Ozzy Osbourne and Hulk Hogan proved that's wrong, you don't come up to 2.8 million. So where did all these extra people come from? Well, if you look at the native-born the foreign-born population, it's collapsing. Now, why is it collapsing? Because the assumption is people, that's a self-reported number. They ask you if you're native-born or foreign-born. Foreign-born, because of the immigration calculation, are saying that they're now native-born. And so now the population data is all screwed up in this country right now. There's so many knock-on effects to what's been happening with this. And the last thing I'll say about this real quick is, okay, the shutting of the border has screwed up the data. We don't know what's going on. If you look at survey after survey, a political survey, the single most popular issue that the Republican Party is doing is closing the border. The only thing that Trump is net positive on is closing the border. That ain't going to change in 3 years, no matter what happens at this point. So if the assumption on Wall Street with the 90% cut probability for a September cut on rates, the Fed, which will impact the dollar. But if that probability is predicated on this idea that we're all shocked that we saw these low payroll reports, get used to it because it ain't going to change. And the more we think we need to stimulate to try and fix this, the more we're going to create potentially a policy error.
I think it's so fascinating because we've constantly been in this debate of what kills this cycle. Because, of course, you had the head fakes of all, as I mentioned earlier, the leading economic indicators saying that you were going to have a recession, then it not happening. And that's the question that comes up the most with clients, of course, of what ends this cycle. And could a very low employment growth or population growth environment start to catalyze something that looks like growth that is sub 1% in the US economy? And how does that filter through to an economy that's been used to growing nominal GDP in the high single digits? And I think then the next interesting question is, does that start to reveal credit issues in parts of the economy that are geared for much higher nominal GDP growth? Because a lot can be forgiven when your top line is growing mid to high single digits. But when that starts to decelerate in a more meaningful way, it is I had a client who used to always say, when the Ganges River rises, even the dead bodies float. And so, at what point, as the river starts to recede on top line growth or overall economic growth, which has been above trend, do we start to see more fractures and cracks in the economy? Which I think is fascinating because, yes, having lower population growth or this immigration policy is negative. It is a way down on growth. We just think Econ 101 of population growth plus capital plus productivity. Is that the equation?
Yeah, it's something
Professor?
similar.
Something like that?
Yeah.
And so, as investors, risk assets have done well because we've been in an incredibly robust nominal GDP growth environment, and that has allowed people to take on more leverage. That has allowed them to absorb higher interest rates. Excuse me, people. Thank you. And so I think that it's a fascinating question of, even if we don't get a recession but growth is just slower, does that actually cause you to reveal more fractures than maybe you had appreciated?
So, just as a sidebar, all those who are thinking about jumping into embracing your favorite new direct lender in a private lending
Is
space.
that you?
I don't do direct lending.
Okay.
I do credit, though. Just so you know, it's something to be concerned about, just as all the amendment and extends in credit. Going back to this, there are two things that I think both of you said that I like, different questions. So, in Jim, you talked about the ADP data as a source and how they could use private enterprise. But I would argue the ADP data doesn't really capture the employment numbers, because you have firms that have historically been competitors to ADP that represent the more entrepreneurial and growing firms, and the ADP represents an older, more mainstaying group, such as Paychex was the original, now you have JustWorks. So knowing that you have these changes going on in the environment, what hard evidence in the private sector would you try to rally so that you don't get a biased opinion that is incomplete because someone's willing to produce it? And how without the government or the Fed behind a movement to get everybody to get the information, are you going to be able to, as a market watcher, to be able to pick up these informations and figure it out?
Well, you're right about ADP, and you're right about any particular payroll processing firm, that they're going to have a certain type of clientele with a certain bias. And you're right, ADP, the largest, is all the large companies, all the established companies. So in terms of birth death models and stuff, there's very few companies start off with, hey, we started a company called ADP to start doing our payroll. But there's lots of payroll processors. Pay them to give you the data. And then they will, and if you do dozens of them and get a vast majority of them, pay them to give you the data in real time. And then you can, and tell them that they got to give you all the information about somebody except for two pieces: their name and their social security number. But I want to know everything else about them except those two pieces. And aggregate it and put out an API and let everybody download it, and everybody can, go to town on that. I think that would be a better source of doing
but
it.
That's a future in the pie in the sky solution today,
Right.
knowing that there's a flaw not just in the labor data but in significant parts of other pieces of data. Right? I wish Leland was kind of here, actually. What is you
wish who was here?
Leland.
Oh, Leland, yeah.
What is you going to do as an observer of the markets
To fix this?
No, to figure out what's real and what's not.
Hire Jill at BLS. We can start with that, right? No, I think
I'm gonna do it 1 second.
Yeah. That's a good question. I mean, how we actually have a broken system. We don't have a head of the system, and we don't have, as I've heard anybody articulate a direction of how to fix it, other than what Trump has done is he's done the little, shiny red ball in the corner
So you
here.
don't have an answer of what you're gonna lean on
No,
right now.
I don't have an answer.
Okay,
Just that
so Cam,
Yeah.
you may
political.
have,
Okay.
Cam may have some insights on
I-
how she
well,
would look at it.
So there's been so many birth death model truthers right over the last couple of years and being like the jobs aren't real. So okay, maybe. I don't know. I have zero idea as to whether that's true or not. What I do know is equity earnings and what the equity market is telling me about the consumer. And so what we've been using as our North Star is effectively, this is the litmus test, is what is equal weight discretionary versus staples doing? It's so simple. If it's in an uptrend, the equity market is still optimistic about the consumer. If it's in a downtrend, the equity market is more pessimistic about the consumer. And it's actually been a pretty reliable indicator about household consumption forecasts within GDP. So effectively to say is that the data may be trash, but the equity market has a fairly good track record of sniffing out these turning points. So we'll use this ratio. The problem is that that ratio of is intending to use an equal weight removes the distortions of things like Amazon and Tesla, for example. But you still have all of these structural issues with staples companies maybe leaning a little bit more towards things that are disrupted by new medical technologies, et cetera. But the point is, it's a pretty helpful litmus test. And until that breaks down, I think that you lean towards maybe we believe the jobs data isn't terrible, terrible, terrible. So birth death truthers aren't real, and that you have some optimism about what's going on within the overall labor market. If that turns, then then doomsday, and I'll drink with everybody.
My second follow-up.
Okay.
question, and then I'm actually gonna open up to the crowd,
Okay.
because I beat you up on a follow-up question.
Mm-hmm.
Great. You've said the markets are relatively good predictors if you get the right skewing of the data for what's going on. The problem is I don't want to wait for the market to make that decision. I want to be able to prepare before that decision of upward trend or downward trend has occurred. So how can I figure that out and get a sense? Because really, some of the more market watchers are focusing on figuring out in the future when those trends are going to occur. So instead of being reactive, what would you do to be predictive?
Read Peter Bookvar's notes about company commentaries from corporate earnings. I don't know if he's even in here.
Okay.
Oh yeah, you're welcome.
So good. Now that we've got this dead can, we can open it. Go ahead.
Question I want to ask. You talked about measurement of data. And it's gotten worse. And what I think is really important to the market and the economy is the difference between bad measurement and manipulated data.
Right.
So how does the market deal in light of the recent events? We're saying, yes, we know the data response rates have gone down. The data maybe isn't as accurate as it was 5 or 10 years ago, but it's not biased. It's put out in an honest fashion. There'll be revisions, but we have faith in the data. Just a wider band of margin of error versus we have people in the BLS or other departments that are going to cook the books. And that's what the market's going to have to deal with. If the employment report for August comes out on September, whatever, and there's a big upward revision to June and July, and August is up 300,000. Am I supposed to tell clients those are accurate? Or am I supposed to tell clients or the market, are we going to tell people? Funny that we had a new BLS administrator and all the numbers got revised in the direction that the current administration wants them to be. I think that's the big issue the market's going to have to grapple with. Not mismeasurement, but manipulated data for political purposes.
And if it's weak in August, what, are we going to fire more people too? If it's weak in August? But you're right. You're right. This was the terrible thing that happened. There is problems with the data, and I was going to say the shiny red ball, as he says, it's manipulated, and now we've got a big credibility problem. I mean, even if it comes in right in line with what everybody expects, there's no magic answer to say that there's not going to be a credibility problem, other than to open up the process a little bit more and tell us more about the process than they're telling us right now. Like, You've got a 58% collection rate. What did you use as your assumptions on the 42% we haven't gotten? What are they? The big one in my mind is in CPI. What did you use as your tariff assumption for the CPI data that you did not get? Because we know that the imputed number's up to 30% now. What is your tariff assumption that you're using? They don't tell us. They don't tell us anything. That's how they're going to have to get credibility back by saying the problem is there's no right answer, right? Because if they tell us that there's anything in there that says that there might be $1 of tariff price pressure upward, everybody
Oh.
is going to get fired.
Dollar.
Not even that it's not just bad data.
Right. It's confidence.
We've had bad data from before you were born.
Right.
And and they use worse. But the BLS has never.
Usually that's directed in my direction, so.
Right.
Of being manipulated, like so many other countries, we've been the gold standard of maybe not that accurate, but believable, best that can be done without political influence. That's what is the big risk and how the markets deal with it. I agree with you, more transparency helps, but that means you're gonna really have to go deep fishing into those assumptions, and you're not gonna know that when the data comes out. That'll take days or weeks.
Right.
Other questions?
Okay, so Stu asked my question, I think Stu nailed it, that's what is on everybody's mind, what happens if the data market, the data starts manipulating? I don't think it'll happen over 1 month, but it could happen over 6 months, and I think we would know about it, because you've got dozens or hundreds of economies. I mean, you would know that there's turmoil inside BLS or any other agency. People would quit, some would, not everybody, but some would quit, and you would know there's a problem with that. So if the agency itself is giving signals that the data is not just, inaccurate within a band, but manipulated, what do markets do with that? And I would like to think more about the CPI than jobs. The CPI is the basis for Social Security COLA increases.
CPI right now is also the center point for the tariff debate. How much is the final end consumer paying? Because we don't separate out tariffs out of prices like we separate sales tax. We do. Part of the reason we separate sales tax, why you pay $19.99 plus sales tax, so we can keep the sales tax out of the CPI calculation. So even, this even opens up another one, right? For the next 3 or 4 months, suppose the inflation numbers don't do anything. They're manipulated because Trump doesn't want to show that there's a tariff increase in that data. So now all of a sudden, if the numbers are staying low, they now it can be questioned.
You will have signals from what's going on inside BLS. You'll know if people are starting to say, I'm out here, or leaks, it could be leak stories that change. It'll happen.
Yes.
It's not gonna.
Are you surprised it hasn't happened already? It's a week too short a time period.
I'm not surprised because it hasn't happened. That's my assumption. I haven't seen those signals.
Right.
So, then it raises the question of how does that get filtered into markets? Because here we all are hemming and hawing about these big tectonic shifts that feel like they're happening, right? We're discussing data independence and reliability. We're discussing Fed independence. We're discussing dollar hegemony. Do it. We are discussing all of
the outlook for rates.
The outlook for rates, but we're discussing all of these things that feel like major shifts. We're rebalancing the entire U.S. global, the global economy and trade. We're doing all of these things that feel like huge moves, and yet, the 10-year Treasury yield has been stuck within a tight range of 4.2 to 4.6%. The 200-day moving average on that 10-year Treasury is flat. It has been on the road to nowhere. We've oscillated around it. We've not had a breakout in either direction. I did not check markets today, so please don't quote me too much on that. But isn't it fascinating that all of these things that we're discussing are all things that, in theory, should raise risk premia to a certain extent? and yet markets have not reacted yet. And
Yet.
maybe it is the yet of if it's a week within the inflation data or a week within BLS leaks, when does it come time that for all of these huge things that we're talking about, it starts showing up in prices? And maybe it is in the very long end of the curve. Peter and I were having a discussion earlier today. Isn't it interesting that if you look around the world with Japanese JGBs or long-term German boons, that you have seen this climb higher? And I was saying that isn't it fascinating that you have German unemployment at COVID highs, now not at 2008 highs, but COVID highs, and you have the German 30-year bund at a cycle high. So is that where we're starting to see some of this? Obviously not trying to connect what's going on with the boon market and the BLS, but are we starting to see that filter through into the very, very long end? I don't know.
You could be. I'll throw out one other thing too. Trump has said that the ECB has cut rates 10 times, yet the 30-year or the 10-year German Bund is higher yield now than it was before the first rate cut of those 10. So it is not only has it not gone down, it's slightly higher than it was during that period. So they have not gone up, you know.
So I've got two things. One's likely, well, they're both observational. The one is that when Treasury yields oil like this, outside of the period when they were in zero bound, that usually immediately precedes something very significant happening. So
I agree with that.
much
Yeah.
higher, much
Potential
longer
energy.
You know, it's not a directional thing, but it's historically what happens. But the second thing was just observational in terms of privatizing data and just pointing out a really good example is managing an inflation fund for so many years. You know, I lean pretty heavily on the Billion Prices project that MIT did, where they scraped thousands of prices billions of prices potential, because that's what they call the project. But they scrape those prices every day. And while that doesn't capture, you know, equivalent rents and those kinds of things, it is a really good example of how private enterprise, right, in this case MIT, can provide really solid data, you know, particularly through technology to traders and investors. So that's
So real quick on your second observation, the Billion Prices project is now owned by State Street. It's called Price Stats.
I think it's tired of mine.
Yeah, and no, I was going to say, what I was going to say is interesting about the project is they say that they're collecting 15 million prices daily. The BLS collects 1 million prices a month, and somehow it can be done. They're doing it right now.
They're doing it. It's just a matter of having, and particularly in this day and age, for inflation at any rate, it ought to be a very simple thing to
Right.
actually isolate the true.
Do you guys know about Truflation?
Yeah.
What's your opinion?
The weighting on Truflation is the problem, that it's too heavily weighted. It does the same thing, right? It collects daily prices, but if you look at their weighting, it's really overweighted in goods and less overweighted in services. You know, somebody said to me, yeah, it does a really good job of telling you what the price of t-shirts are in the country, but if you need teeth cleaning or lawn mowed, they're not getting those prices. So, and we know goods prices have a lower inflation rate than services prices. So where I think they make
And more
their
volatile.
and more volatile. Where I think they make their mistake is, I don't know, they're really on this idea that the Fed is making a giant mistake because of the low level of their the low level that they show the inflation rate at right now at around 2%. I think the better way to use that is the rate of change, and the rate of and the rate of change.
You gotta get us a chance to have a drink first before you go in.
Yeah. I just want, we're going in the chug mode.
So, Claudia?
Yeah, so I would say on the aspect that the private sector will save the government statistics, like, it's not gonna happen. I mean, I Bloomberg opinion piece today is actually on this topic, and I mean, one of the things is you can have 15 million price quotes. They're not representative of the United States. You do not have to measure inflation for the US.
Agreed.
You know,
They are a measure of consumer prices, right?
No, you have to, they have to be representative, so that's what I think of statistical agencies, they create a sampling frame, they create, and any of these, whether it's ADP, and I work on big data stuff at the Fed, they'll use like.
Oh. Thank you, Claudia.
You know, people to benchmark and to get them represented, so you can have a partnership, you can use this private data, and the statistical agencies have more and more been bringing in, I think we gave an example with J.D. Powers. It's a matter of cost, it's a matter of quality, and the statistics have to be reliable, right? Like the CPI goes into social security benefit, goes into the tips contract. The thing is, private companies may be in the business of like sharing their data and then profit motives go somewhere else, or, you know, the priorities change and the data disappears. Or you have a holdup issue. Like I can sure, I have been on calls asking these big companies, like, can we have your data? We don't do public goods. What are you talking about? You know, like, you wanna pay this million, 2 billion, you know, so there are real issues, but it is a tough.
As they said, pay them $2 million. You got a $600 million budget at the BLS.
You know, inflation adjusted has been declining, they have big cuts coming up again, the agencies don't have the money, so there's a path forward, but I don't think like private sector isn't gonna.
Then call carpet Palantir.
Say that like getting away from BLS, we don't have a measurement problem, we have a policy problem. In the sense that we have had really major changes, like policies that go into effect, like with the tariffs, they came out very quickly, we saw these massive like, you know, imports trying to front run it and kind of like huge, and talking to people at PA, like that was, this is, people have been there decades, we're like, this is the hardest GDP estimate we have ever had to do. Because imports should have nothing to do with GDP. GDP is about domestic production. Domestic production in the United States did not decline in the first quarter. It's just these imports, like isolating them out of the consumer data, the business data where they're mixed in, so they have to make assumptions about inventory. So like that was so hard because we had a big policy. Yes, we had a big revision, a downward revision to payrolls. Those tend to happen when things are like changing really fast in the economy. So like the conversations like we've had going from really above trend immigration to like hits the floor and like losing work authorization for people who already had status. So and measurement, like, you know, no matter how good it is, and frankly, the measurement is better in the US than it was ever. Like they're always, you know, modernizing things better. But like you push it to the test and like that's what happens. So I think it's, you know, kind of focusing on the data or telling us as opposed to let's fix the BLS, which give them more money, do modernization, private public partnership, like all those things are awesome, but like the economy is doing things.
I think you're right, though. Just one quick thought is that in the first quarter, as we know, net exports was a huge drag on GDP, but they made an assumption in the data that where did those net exports, where did all those imports go? And they assumed inventories higher. And that would actually benefit Trump. You know, he didn't give them any gold stars for doing that in the first quarter. But again, you're right. We're almost at the point now where I don't need the data. I just need you to tell me what your assumptions are that you used, because that seems to be almost more important than the data. And if we could get better data, we could stop doing assumptions, is what we're doing. Because it all really comes down to that. It really comes down to the assumptions they're doing to plug the missing data and where we're going to go.
I think there's also a company plot twist here where no company wants to admit that they're struggling. That's on like public earnings calls, because heaven forbid that they come under the ire. Look what happened when Amazon said we're going to reflect tariff prices moving higher. So I think that if you look at the second quarter beats and raises, I think part of it was the fact that no company wanted to raise their hand and said this sucks. Like they're all pulling the levers that they can in order to, whether it's FIFO accounting and all the inventory drawdown, hoping that there will be a backing off of some of this tariff activity.
I'm gonna give a live example.
Okay.
Sorry.
No, go ahead. Yeah. Here.
No.
Okay.
Retailer was gonna make $40 million estimated earning EBITDA this year. They had a call with their creditors. They're gonna lose $20 million of EBITDA this year, of which $52 million is directly related to tariffs. And they don't think they can pass it on because it's a retailer.
Is this hypothetical?
No, this is actual. Okay. And if we weren't on tape, I would tell you the name, but I can't under.
Fair.
I was just giving an example.
Oh, yeah.
To support your comment.
To your point, he's talking about MIT academics and peer reviewed and much more transparent than getting data from the big three tech companies.
But you've got to understand that data is only on consumer prices that, you know, it's.
Mostly goods prices.
It's much more, yeah, there's a lot of food prices, consumer goods, but I was just simply referencing it as an example of what kind of private data is actually available, not necessarily is entirely reflective of what CPI is.
But it tracked it pretty closely. My memory serves, the Billion Price project, which I followed when they were back on MIT, it was pretty lockstep with CPI over most of it.
Running a fund and actually investing, I felt like it was reasonably good input, right? So, not the whole equation, but it's kind of significant part of it. And I trusted it, and I liked it.
And here's the other fun plot twist with this is that we could all be talking about the path forward for something like CPI and say, okay, we think it's going to reaccelerate for X, Y, and Z reasons. What does the Fed do with that? Do they still like? I like the open question is like, what is the pain point on inflation that they will not deliver the rate cuts? Thank you. That they will not deliver the rate cuts that are expected, no matter who gets put in the Fed chair position.
Yeah, quick scenario for you. Tuesday is CPI. What if it beats? What if it beats? What happens to the September rate cut at that point? I think it comes down to what Powell says at Jackson Hole at the end of the month. And if he says there's going to be a rate cut, there'll be a rate cut. If he says there's not going to be a rate cut at Jackson Hole, does Trump fire him before the September 17th meeting? Mm-hmm.
So as a retired cash, should I buy my 3-year notes right now?
So
Your curve steepeners, Stu.
So just a few bullet points I want to throw out for people. To think
Is this a
about.
question or a statement, Barry?
So it'll be a statement followed by a brief question and answer period. So first, allow me to remind everybody that we used to have the private sector data set rates for LIBOR. How'd that work out? Number one.
A lot of
was a
really
survey.
great lunches.
It was a survey.
It's a survey of trading.
All surveys are bad. All surveys are bad.
You know, that.
Earmuffs, Holly.
Surveys to use to try and approximate real data, not attitudes. Not attitudes.
So that's the first thing. The second point, and I'll turn this into a question, is, you know, we're extrapolating out from 6 months of this presidency and just drawing a straight line in one direction or another. The economy is much more dynamic than that, and perhaps it gets much worse. And then there's a political reaction. There's an election 14 months away from now. I'm hearing a lot of, here's how terrible this can be off in the next 5 years. I want to ask your view, how long does this current policy stay in effect? What sets it aside?
What's the current policy?
The tariff policy, the authoritarian policy of firing anybody, there can be no other opinion but mine, just the whole gestalt.
So when does he taco is basically what we're asking at this. Yeah.
It's not a talk.
Definitely on a Tuesday. It will happen on a Tuesday.
Okay.
It's less taco than a collar when the market's down.
Yeah.
That's when taco shows up.
That's exactly what I was going to say.
So it's really a Trump collar, not a Trump put. But
I agree with you. I think that it's going to be market signaling that is going to force some kind of change. We closed 2 points or 3 points off the all-time high today or something like that. And that was after the big dive in the market last Friday. So we've completely recovered that. And if you look at Trump, he finally broke this week and had 2 long Truth Social posts basically extolling the virtues of the beautiful stock market going up and up and up. He hadn't been talking about it at all until this week. So that's it. I think it really is the market. It's the market. People keep wondering about when is he going to cave on tariffs? When we're down 10%, when we're down 15%, if we're at all-time highs, he's going to just, I put 25% tariffs on, but I'll do 30 because I can. That's the risk you face if the market keeps going up.
So, and this raises the question of the revisions that we had in the labor data. Is this a runaway train when it comes to a softening in the labor market, meaning it only gets worse from here? We've seen this deceleration. And so if it only gets worse from here, if these policies stay in place, then it raises the question of if the Fed cuts rates by 100 basis points, does it do anything to help that?
So let me offer something about that data. The revisions, the 2-month revision as a percent of the workforce was 16 basis points, minus 16 basis points. It's the second largest in 43 years. The only larger one was April 2020, when we had 20 million job loss. But that one we can explain because we shut down the global economy and sent everybody home. We don't usually do that, but we did that in April of 2020. Every other time you've seen revisions in the 2-month data that big, you could go back and say something changed, something changed, something changed. And that something changed is usually a recession began. But this time, I think the something that's changed, I will postulate, was we shut the border and the growth rate of the population went bam right to zero in the last 90 days. And I think that's what's really shocked the data that is starting to show up. We assume certain amount of people in what?
Do you think that the tariffs are less significant than the border shutting?
For the payroll data, I think it is the population growth. Tariffs are probably more significant for the inflation data. So it depends on which set of data you're using.
And real personal consumption is negative year to date on an annualized basis. And so I bring it back to what would Fed cuts actually do for consumers?
If the population growth is zero, it's not going to do anything.
Well, also,
And you guys are behind like 3 drinks right now.
it's the constitution of the balance sheets, right? So you look at credit card rates right now; they are down by please. They're down by about 40 basis points from their peak, and they peaked back in October of last year. But if you look at the rates on money markets, they're down far further, of course, because those reset immediately. So the challenge you have is that you have $7 trillion of money market balances in this economy where people, high-income consumers, savers, have been enjoying very high rates. Drink. The question is, people won't get rate relief from the interest rate cuts at the front of the curve from the Fed. Just like chug.
You're gonna kill them here with this answer.
Problem here.
But they're getting pinched on cash interest income. So it's a very through the looking glass kind of environment, which just means that I don't think that rate cuts will be as stimulative to the consumer as they have in past cycles, obviously, because we all know about the mortgage data and how only 7% of mortgages are floating rate, et cetera, et cetera. So, I guess the question would be is that if we get those rate cuts, no matter what, could we actually see consumption take an even further step down or deceleration further because you're seeing the income from interest get pinched?
I'm going to postulate something real quick about mortgages and housing. Every day I've been alive, currently, and every day I will be alive, housing will be in a crisis. It will either be prices are going up and it's an affordability crisis, or prices are going down and it's a financial crisis. Right now, home prices are at an all-time high and it's an affordability crisis. What I fear is Trump is saying cut rates because we have an affordability crisis. I think if we cut rates, people are just going to raise the house price and your monthly payment's not going to change. We're just going to 66 million people own homes. 66 million people want to see rate cuts so they can call their broker and tell them to raise the price of raise their offering price. That's what I think is it. If you really want to fix the housing problem, you really got to fix the zoning and building regulations problem. But nobody wants to touch that because what does everybody do when they buy a house? They get interested in making sure that nobody builds a house next door so that you can constrict the supply. That's the real problem. It's not interest rates. So I think if you cut rates, you're not going to do anything for.
Massive decrease in housing inventory, because so much of the population of mortgages are sub 4% mortgages. They can't afford to trade up because they don't want 7%.
Well, that would be fixed by lower prices.
Yeah, by lower rates, not by.
Well,
But by
but
lower
if we see-
prices.
Right there.
But if we see inventories go up, I mean, if you start seeing more velocity in the inventories, could actually the falling rates cause prices to fall as people move out of their homes
Jonathan
more?
Moore's last report said average inventory across the country is 75% below 50-year averages. Your 1 out of 4 houses that should be for sale is for sale. So even if you double it so you're only half the inventory,
Right.
you're freeing up a little.
But if
And-
you
and
cut
why are
if
we-
you cut mortgage rates, they're going to raise the house. They're going to raise the offering price, and you're back to the same monthly payment. That's the risk. This is the funny thing about affordability crisis. 66 million people are looking at their Redfin and Zillow monthly numbers and going, "I don't see any crisis. My house is at an all-time high, and the old all-time high was last month." That's what everybody's seeing right now, and that's why they want prices to be. That's why they want mortgage rates to go down, so they can jack their price even more.
Except they don't control them.
But
So the Fed doesn't.
Right.
Yeah. So,
I'll say that Terry Wolf was one of the names we read last night on the memorial, who used to be a camper here, and was the smartest mortgage person I have ever known. I mean, he continually made the point that housing is all about monthly payment. You start from how much you can afford every month, and that's the house you decide to buy. So it's a consistent teeter-totter between rates and affordability, right? And it's both, but you know, if you've got $2,000 a month that you can afford for housing, that's interesting.
Yeah.
Moving on.
Yeah, but you're right. You're right. According to the National right. According to the National Association of Realtors, the average monthly payment for an average house is $2,900 a month. You need $100,000 income in order to buy that, and the average new home buyer has a $60,000 income. Now, if you cut, like I said, the problem is that I think everybody's saying $2,800 is the number. You cut mortgage rates, we're going to raise prices, so we're back to $2,800. That's the risk you face, that you don't fix this with cutting more, assuming that rate cuts actually bring down mortgages. I'm making that assumption for this discussion.
which it's a bold assumption because
Right.
it's just not.
Right.
Yeah.
Look, when the Fed lowered rates, they had an unintended consequence. They allowed people to lock in low rates.
Well, so 2010, there's an open letter to the Fed from a bunch of bank presidents. I think it was 2010, saying QE is going to be inflationary.
It was the private sector, I thought they'd get.
From
Hedge fund guys as well.
yeah, I mean, not Fed bank presidents, but
Yeah,
like
yeah.
bank private.
And there was
private-
some campers. There were some
campers.
campers that are not here right now that we're talking about that signed that letter too.
and in a funny way, like they were right, sort of ish, but just a decade too early, because that policy and that fever pitch, yes, that would be wrong in some camps, but that policy ends in the fever pitch of 10-year Treasury yields hitting a low. I think we just had the anniversary a couple of weeks ago of 0.5%, and so in that decade of policy, decade plus, you effectively desensitize the US economy to short-term interest rates. Look at the percentage of corporate balance sheets using commercial paper. Nobody uses it anymore. And so as the Fed raises rates for the first time ever, and this is in the BEA data, you saw net interest expense fall as the Fed was raising rates in 2022 and 2023.
I would premise that if you didn't have an inverted yield curve, you would see more commercial paper usage by corporations.
Yes.
Yeah.
But you didn't see it even when the curve was steep going into the pandemic. They didn't use it when it was strong.
Yeah, it plummeted post GFC.
So, I'm gonna say something that is kind of.
Because they termed out their balance.
Yeah, that was the whole point. Yeah.
Kind of trite, but true, and everybody knows it, that markets are not the real economy. So if we're just limiting the discussion to returns for investors, then all this focus is appropriate. But if you're talking about, if you want to talk about possible election outcomes and impacts on politics, you do need to factor in the real economy. And talk to me about the K-shaped economy, why consumer attitudes are at recessionary levels at the same time that the S&P 500 is hitting a rise, about why the landlords everywhere are throwing out incumbents. Could that happen to Trump? Just because there are deep underlying problems, prosperity is too elusive, and Trump can't fix it, etc.
So,
wait.
Yep.
That'll be our last question for them to address. And then we'll break and let everybody else continue the conversation in a more casual setting. Here we go.
But I'm keeping the microphone. Rest of the night.
Well, you are the stage.
Yeah. It's
Rick,
karaoke night.
All right, go ahead.
50% of retail sales is now from the upper 10% of income, and that's the most concentrated it's ever been. Right now, you only need 10% of the population to feel good about things, and you're going to get strong CPI, you're going to get a lot of strong GDP numbers, you're going to get strong retail sales, you're going to get stock prices going up. We also saw a study done by Indeed last week that they still estimate that somewhere between 35 and 40% of the workforce is getting raises less than the inflation rate. It's less than 50, but it's still,
What's trending?
Well, 2 years ago, 3 years ago, it was like 60% were getting less than inflation, or 70%, but now it's still 35 or 40. Who are those 35 or 40 that are not getting those raises less than inflation? They're the bottom 35 and 40. They're the people that go to the store and say, I got to buy less things now because my paycheck is not keeping up. All of us here in this room, we just say 4-letter words and pay for it because we can, even if we have a paycheck that did not go up by 3% in the last year. So there is a lot of discontent. And that to me explains why, because you hear this from political pollsters, people still say the number one issue in the country is inflation. And then they say, but it peaked at 9% 3 years ago, and now it's at 2-something. It's been fixed for the 10%. It's been fixed. It has not been fixed for the bottom 40%. That's the K-shaped economy.
So the economists say, or those surveys say it's inflation, but it's really affordability.
High prices.
Right, it is. It's high prices and affordability. Yes, just like with housing, it's affordability.
Yeah. What consumer knows what a second derivative is?
What
Second-
economist knows what a second derivative is?
Keep going.
Well, look,
Let Cam keep going. Let Cam finish up.
Well, just I would say that the market will eventually be the economy, right?
Well, let her.
Reflect.
Guys. Let Cam finish.
Well, I think be and reflect.
Okay.
Be and reflect, because the concentration of stock assets in this upper income that generate most of the consumption, that being a very important part. If you were to see a protracted bear market, it likely feeds on itself because the wealth effect has become such an important driver of consumption. But at the end of the day, the largest weights within the S&P 500 still are very cyclical businesses that are sensitive to the U.S. economy. So we bring it back to the start. We've been in a strong nominal GDP environment that's been very good for things like advertising businesses. Advertising businesses like Meta, that's 98% advertising, or Google, that's 92% advertising. So if you start seeing some of those things slow down, I think that it in theory, assuming that you don't have a bubble-like environment like 1998, 1999, and early 2000, where you really do see the fundamentals deteriorating and stocks just in a true melt-up environment. But eventually that earnings start to come home to roost right at the same time that they're spending so much on CapEx, that at the same time, if we think about the market related to the economy, is that Neil Dutta put out the stat that the contribution to GDP in the second quarter was greater from investments in data infrastructure than the consumer. So I think that this is all incredibly intertwined, and because of the exposure of consumers to the equity market being at all-time highs, according to the Fed data, got to get it in there one last time, drink everybody. Because that is at all-time highs, it means that their sensitivity to equity markets is at all-time highs, and that's our positive and or negative feedback loop.
Now, we're gonna break up. They're available for more.
Please say,
We're
it's
gonna,
not about
one second. We're gonna break, I'll leave it, but we're gonna break up. They're available for further questions and groupie signatures afterwards.
Since we're recording, I just want to say real quick, John Malden, come back.